The inflation report came in hotter than expected. Here's what you need to know.
Okay, let's talk hotter inflation. Here's what you need to know. First up, CPI came in above expectations. That's the third month in a row that this has happened. And several critical categories don't look so good. Here's the BLS reporting on inflation, CPI. What you see here is this blue line that you see here. That's headline inflation that includes food and energy, which are pretty volatile. This red line that you see here, that's core inflation, which removes those categories. And this is the one that the Federal Reserve really focuses on. And what you notice is if you look at these two lines, they're coming down. So what's the big worry? Well, these lines, this is the 12-month inflationary trend. So it's looking at the last 12 months of history. There's a lot of old data in these numbers. If you look at the month-over-month data, which is the data that I have here at the bottom of the chart, you can sort of see that the burner is being turned up some more and the pot is starting to heat. And I think if things continue this way, the water's going to start to boil again. Here's what I mean. October, month-over-month inflation was 0.1%. Good, nice and cool. Then as you get into November and December, 0.2. And if you multiply 0.2 by 12 to give you an annualized rate, that's 2.4. That's still, pretty consistent with what the Fed's mandate is. But then January came in at 0.3. Uh-oh. Then February came in at 0.4. And if you multiply 0.4 by 12 to get the annualized rate of inflation, now we're up at 4.85% inflation. And that is way too hot. That's above these trends. And so what we're seeing on the month-over-month data is inflation starting to heat up. If you just take the last 3 months worth of history, core inflation is somewhere around 4.2, which is up here on this chart if it were to keep up for the next 12 months. So inflation's coming in hotter, third straight month of this happening. And what's interesting is if you look at this inflationary trend, because if you'll remember, recently I said, hey, the inflationary episode is over. And that's true in a conventional sense. If we look at what's happening with inflation, food, 2.2 over the last 12 months. Totally fine, perfectly reasonable. Energy, deflation, down 1.9. Great. If we go to commodities, the things that we use for manufacturing, down 0.3. Also good there. Apparel, 0. Used cars, down 1.8. So everything looks good. Where's all this inflation coming from? Well, it's all coming from services. Services over the last 12 months up 5.2%. Shelter, 5.7%. Transportation, 9.9%. These are huge numbers, and they're accelerating. Now, when I say services are getting hotter, you might not really know what that means. So I wanted to include this from the Kobayashi letter. He gives you a good rundown of when I say services are coming in hotter, what am I talking about here? What is a service? How about car insurance? Car insurance inflation is up 20% year over year. Transportation, that's trucking, that's taxis, that's airplanes, that's flights, 9.9 year over year. Car repair, 6.7. Hospitals, 6.1. Homeowners, 6. Rent, 5.8. Food away from home, that's restaurants, 4.5. Electricity, 3.6. All of these categories are well ahead of the Fed's 2% mandate. And that's really what we're seeing in this inflationary trend. We did excellent job, raising interest rates, and that decreased demand for housing, that decreased demand for cars, and that caused the goods deflation, the oil deflation, the disinflation, all this stuff that we're seeing. But we're really at the limits of that stuff, right? If the car market is weak, they're going to produce less cars. If the goods market is weak, they're going to manufacture less goods. This services inflation, we really haven't made much progress on, and I don't know that interest rates can fix this. I actually don't know how to fix this, and I don't really think the Fed does either. In the 1970s, the last time we had to fight inflation, the U.S. economy was primarily manufacturing and goods based, and so the interest rates worked. I don't know that they're going to work now. So, unsurprisingly, if you see what the market did with this data, and this was one of the things that I talked about for this year, we had a lot of expectations for rate cuts. We were expecting 6 rate cuts this year. That expectation is now down to 2.6. From the start of March to now, we basically went from 4 rate cuts down to 2.5. And so what they're saying is the market is very quickly coming around to the idea that interest rates are going to have to stay higher for longer. And this was one of the things that I was a little nervous about this year because we've got such high expectations. The economy needs to be good, rates need to come down. And the first thing that we're seeing here is rates might not be coming down. So what does it all mean? Hotter inflation again. CPI continues to be stubbornly high. Interest rate hikes have done a good job of reducing commodity and goods inflation, but that's not the whole job. The Fed's actions thus far don't seem to be working on the service sector of the economy, and the U.S. economy is primarily service-based. And so what this is doing is expectations for interest rate cuts continue to fall, and so this is giving me some nerves, simply because this interest rates coming down was one of the things that, this bull market that we're in was built on, and it looks like reality is not going to live up to the expectation or the projection. So we'll see. Hotter inflation again. I'll see you for the weekend review. Bye.